All right, thank you guys all for joining us on this Friday, and we're going to be talking about how to make money in sideways markets. I don't know if many of you guys have been watching the stock market, but just saw a little bit of information today. The stock market has been up as much as it's been down this year for the most part on a daily basis. Day by day, it's up. I think 51% of the time, and been down 49% of the time. So it's been up a little bit more on those days, so it's kind of made the market go a little bit higher, but for the most part, it has been a sideways market, which is going to be great for the strategy that we talk about today. So thanks for joining, and my name's Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or the Wall Street Journal, where I've commented on everything from geopolitical to economic and market analysis. I've been trading my own money for over 20 years now. I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your portfolio, and most importantly, manage your own risk. Uh, so, like I said, I've traded in most markets throughout my career. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products and in all market conditions. As you can see, this was a crazy Fed day where they moved rates a little bit more than what was expected. Anyway, I got to go over this disclaimer. It's basically just telling you guys that, we are here just for general market commentary. We're not trying to give you investment advice or solicitation to buy or sell any security, because I don't know what you guys already have in your portfolios. I don't know your risk parameters, and therefore I can't possibly give you a particular trade recommendation, because it could actually be counterintuitive to what you are already doing, and it might be outside of your risk parameters. So at the end of the day, do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, with that out of the way, this is going to be on how to use strangles to generate income. Now, like I mentioned right before we went on, I am a options seller. I don't like the idea of buying options. It's a decaying asset for the most part, and I like to take advantage of that and watch that come out of my premiums. When you're selling options, you're really not looking for the home run. You're looking for the singles and the doubles to increase your income and your overall yield. When you're buying options, you're really looking for a home run, and as you know, even home run hitters strike out more times than they even get a hit. So I've known people to make a lot of money in buying options, but at the end of the day, they're one-hit wonders. Whereas I would like to generate that income on a daily basis and keep moving trades along. So like I said, this is going to be income generation with short strangles. I'm not going to be talking about buying anything today. It's just a short strangle strategy, which is a non-defined risk strategy. So if you have a low risk tolerance, then you should look at defining your risk on these types of strategies. And we've done one on condors. So if you go to protraderstrategies.com, you can check that one out. It's kind of like the strangle, but it has defined risk, so you can limit your risk. But it also limits your amount of money that you're going to collect as well. But the essentials to success is going to be picking the right strike. Now, I like to try and look at one standard deviation. If you've ever looked at the bell curve, it's one standard deviation out, which kind of puts you outside of the bell curve, and it keeps you outside of where it is likely to trade. It generally gives you about an 80+% probability of staying out of the money. There is a big probability that one of your legs is going to be touched, probability of touch, but we are looking for it to stay within our strikes. And so we're going to push our legs out a little bit further than I would like even in an iron condor for that matter, and get a little bit more premium than an iron condor, I should say. And picking the right duration. Now, what's the right duration? Now, a lot of people, just go at it whenever they see the opportunity. I see the opportunity as being right within this zone right here. This is where I call the cash money zone. I don't like playing 10 days to expiration. There's too much gamma risk and delta risk that happens in that area. It just gets a little wanky and can eat up some of your profits. That's for a different time. The more for the weekly, or those are the types of trades I'll put on for like the earnings that we have going on. But I'm not going to talk about that today. What we're going to talk about is really trying to enter these trades between I like to get in around 45 days for the most part, but we're right around this area. And as you can tell, 35 to 10 days is where you're getting 50% of your theta decay happening. Now, of course, it does speed up. As you can tell, it speeds up all the way along the line, really starts speeding up here, and then dramatically drops off here. But like I said, there's a lot of other things that go on within this time frame that can really negatively affect you and your strategy. So I like to get in and get out within this time frame here, and that will happen more times than not. So having said that, and picking the right environment. What's the right environment? Well, you want volatility to be pretty high, and I make it a rule that the volatility percentile, has got to be above 50%. And I will go into this a little bit more in detail when we go through the live trading area. But it basically is, everything has an IV, and if you've heard of like the VIX or something like that, that's a volatility gauge. But each stock or each instrument we talk about has its own implied volatility. And what we do is we come up with a implied volatility percentile, and I'll show you even how to figure that out. There's an easy way to do it on Thinkorswim, but I'll give you the math on that later. But you want it to be above 50%. The reason why is if volatility expands after you put on one of these strategies, that's going to increase the premiums. And even if you're directionally right, even if you've got that theta decay happening, the volatility expanding on you can keep you from making money. So what I like to do is get in when it's a high implied volatility and take advantage of that. When it contracts, you will really see that that premium decay really quickly, even faster than what the theta can do. So we're going to be looking at IV percent above 50% for all of these trades. Otherwise, I'm going to likely kick it out. I mean, 48% or something like that, I might take another look at it if the chart sets up and I really like the idea of it. But for the most part, above 50% is my line in the sand. And you want to pick the right underlying. The right underlying means it must have a lot of volume and open interest. You want a tight bid-ask spread. So for the most part on these strategies, I'm going to be looking at strategies that you've all heard about, like the Apples and the Twitters and things like that. The reason why is because there's a lot of open interest in there. There's a lot of players out there that are in those, and you get a tight bid-ask spread. The reason why I like that is because when the going gets tough and the markets start moving back and forth and juking up and down, then those spreads will widen. That bid-ask spread will widen, but you're still going to have a relatively tight one. If you pick a stock that has 50 cents or $1 wide strikes, when the going gets tough, those strikes are going to go out to $2 or $1.50, which you're giving up 50% or 50 cents is a big take from what you think you're going to be making. So if you got to give up that edge, it's no good. And know your exit strategy before entering the trade. Like I said, I look at a 50% profit margin or 50% of max profit. So if I'm getting $1, I'm looking at getting out of this trade as soon as I see it go to 50 cents. I mean, if it's 2 or 3 days, I am definitely getting out of that trade. If you guys have been watching the daily market commentaries, I've been scalping basically in and out of Apple the last couple of days. I mean, I've been able to sell some puts in Apple, watch the spike happen. When it comes back down to the trend line, I sold, I sold it when it spiked up, sold the puts out, and then sure enough, 2 days later, it came back down to the same level, and I was able to sell those puts again and covered them. I think it was today, or it was yesterday, maybe I covered them. Actually, it was today when it popped. So I was able to get in on that again. So, and I did that twice on 50% profit margin. I think I sold them for 60 cents and bought them 65 cents and bought them back for 38 cents. It wasn't quite 50%, but it was close. So get out at 50% if you've got the opportunity. This is a little bit of a cheat sheet that I kind of go by. It's, you know, if I'm in this trade for only 5 days and I'm 15% of max profit, I'll probably cover that trade. And, you know, if I'm in that trade for 5 days and it's anything above that, I'm definitely going to be covering that trade. So I usually look to get out of the trades between 20, 25 days after putting them on. And, you know, I'm hoping to get at least 50% of my max profit. So right in that area. But if anything happens, 15 days I'm in this and I'm at 40% max profit, I'm taking it off. There's just too much risk that can happen, and likely not ever going past 35 days. I'm going to be really looking to get out of that trade. Even 35 days, I'm going to be looking to just reallocate that money somewhere else because the trade's just not working for me. There's no reason to just have your money tied up and it's not working for you. So just a little cheat sheet for you guys. That's what I look for when I'm looking at trades after I put them on. Constantly looking at the premiums and seeing if I can get a percent of my max profit and then move on. All right, so your max profit on a strangle is just the net premium that you received. So if you received $1 on this, you know, you multiply it by 100, you'd get $100, and that's the maximum you're going to be able to get. So I would be looking to cover it when I made $50 on that trade, for instance. And your max loss, you got to remember, there's going to be 2 of these. And the max loss for the upper band is going to be when the underlying price is, you know, greater than the call strike plus the net premium. And it's going to keep continuing to get, you know, go against you if it keeps going higher. If the underlying's, you know, we did a 50 strike and the underlying, and we got $1 for the entire thing. You know, as soon as it goes to $52, you're starting to make a loss there. And your max loss is unlimited on the call side. A lot of times people say it's unlimited on the put side, but we all know it can't go past 0. So, you know, you have to keep that in mind. And on the underside, as long as the underlying is going below your short put by $1, that's where you really start losing the money. So, and I will talk about how you can defend this as soon as the underlying trades above that short strike, what we're going to do in regards to that. For instance, if we did the 50 calls and is trading, say 51, and we're basically at a break even or 52, then I'm going to roll these puts up and create a tighter strangle. And if it goes against me again, I'll probably roll it up and create a straddle, which is selling the same 2 strikes. So that's how you defend that. And I'll go into that in a little bit more detail as we go along. And the break even, I kind of touched on that. The short strike has 50, and we get into $1. Our break even is going to be 50 when the underlying is trading at $51. If we did the 45 put and we got $1 when the underlying is trading at 44, that's your break even. So anytime you go on against your break even or you start losing money, that's when we're going to get defensive on this trade. So let's go into the platform, and SPY, I call this a rush to the Hamptons on a Friday when you just have an inside day. It's because every trader in New York is at the Hamptons by now, so the market really quiets down. All right, so I've done a lot of different, like looking for different stocks. You know, you guys can throw out a couple that you guys are thinking about, and I can run this through my rules and figure out what might work. But a couple of them, I narrowed down about 30 stocks that were trading at high IV or relatively high IV and ETFs, and I came up with a few of them. One of them was Twitter. Everybody's been looking at Twitter lately. Twitter does have above 50%. You can go in here, and this is what I was talking about. So let's look at Twitter. So right here, here's the IV percentile. So anything above 50 meets that criteria we are talking about. And this is what we want, because we want it to decay or contract, I should say, and go below 50. So this might work. Now, I'm likely not going to do Twitter, only because they got a lot of crazy things going on. They don't really have a CEO right now, and as soon as something happens, if the market likes the CEO, this market's going to spike. If somebody doesn't like the CEO, it's going to fall out of bed. So I'm going to stay away from Twitter only for that reason. The outside thing, the black swan event, I guess, if you will, on that particular stock. So I'm going to stay away from it. So the other one, I just took off. If you watch the daily market commentary, I took off Win. Win is up in the upper band above 50, so that one looks pretty good. Win has been in a pretty good trading range, even though it's at the bottom of its yearly move for the most part, and 52-week area. So that might work. You can tell it's been flatlining. I think this is where the market's finding value. So I don't really see it moving too much lower. It did come out with worse than expected earnings. So it could trail off a little bit, but the beauty about the strangles is we'd be able to get pretty far away and do like the 120 strike, which would be above this resistance area. The market might want to try and cover this gap, so that would be something I would take into consideration also on selling my calls, is the market might want to try and cover that gap sometime, and I wouldn't want that to really affect my short strike. So that's something to consider also. But what I would look to do is go into Win, pull up 35 days, because we're right in that sweet spot. It's perfect timing for something like this. So this is the delta, the gamma, and the theta. What I'm going to be looking for, and I also already have it on strangle, I'm going to be looking for a delta that is in the teens. So, the 17 works. Usually it's right around 14, 15, 16 is what I'm looking for. This one has a 13. And the reason why is because that's where you get your probabilities of being out of the money. So, we're looking at something to have in the 80s or 85, 90, 85-ish area is kind of right in between that 15 strike area. That gives you about an 85% probability of staying out of the money. That's what we're looking at. It's all about probabilities and math, you guys. That's the beauty of it, is you just play the probabilities. It's like you end up being the house in Vegas. Vegas knows they can buy all those lights because they know the probabilities are in their favor. And eventually, of course, you hear about the guy who hits the home run in Vegas, but for the most part, all those other people sitting around there are paying for it. So if you can be the house and play the probabilities, you're going to be a lot better off. So in this regard, I would be looking at something in the teens, which gets you pretty far away on a stock like this. So this teen gets you to the 105, maybe the 110, and on the downside, we are looking at the 13, which gets you the 80. So 105 to 80, and I would go back to the charts and just kind of look at it. You can see that it stayed in this range, but that 105 puts me, right in here, right in that trend area. That's where the market's been finding value lately, despite the fact that we've kind of sold off. So that would kind of make me a little bit hesitant on this one, because I could easily see this market come up and test that resistance area right there. If we could get it out there, but that's not going to happen. So that would make me probably discount Win. Now, a lot of people say, you know, why do you even look at the charts and stuff like that? I look at the charts because I look at this as the psychology of the market. All of these days are when the bulls and the bears are fighting and who's winning and who's not. And when the bulls give up or the bears give up, that's when you see those big moves. But it does give you a good indication of the overall market feel. So you're not like stuck in just thinking what you see is right all the time. You can kind of look at these and see what the market does. I also use Fibonacci retracements. The reason why I do that, because everybody's looking at them, and if there's a lot of people looking at those, they see it when it hits that Fibonacci level also, and that's usually why you're going to see a bit of a move off of those levels. Is it because it's some kind of crazy mathematical thing, or is it just because everybody's looking at it? I think it's because everybody's looking at it for the most part. I don't know if it's the stars aligning or anything like that. But so something else we could look at, what did I do? Twitter. Another one I looked at was Freeport-McMoRan. Because, you know, the other thing is a $100 stock isn't going to fit in everybody's portfolio. You know, you need to have some good capital in there to be able to trade a undefined risk strategy. And if you're trading in an IRA, you can't use this strategy in an IRA. It's undefined. You'd have to do something along the lines of the condor, or the iron condor, I should say. So you can get that sent to you too. So Freeport-McMoRan's been just trading along this, and full disclosure, I do have a position in Freeport-McMoRan. I'm short some puts. I'm short, actually, I was short puts up here when I thought it was going to start rallying, and it's come down. I'm pretty much getting tested on my 10 puts. I'm short 10 puts, long 9 puts, and I've been getting tested on that, but it seems to have found a bottom here. It seems like it's wanting to settle down a little bit. So, and it's got 100% IV. So, here's one quick note on the IV percent. This is how you can figure it out. Because sometimes I like to, if there's a crazy event outside of the earnings, because you can always see the earnings. Well, in Freeport, of course, it's not spiking on the earnings, but let's say, let's look at Apple real quick, because I think Apple does it a lot. So you can see Apple does the spikes you'll see this a lot with stocks, and that's why a lot of people like to trade the weeklies, because you get this vol contraction right after the earnings announcement, and you can be directionally wrong sometimes, and that vol contraction will make up for it. Not always, but sometimes it will. So if you had one of these major spikes like this one, and it was higher than where it was for the different types of those, but the different earnings events, you could possibly discount out one major outlier move. So what the percentile is on, you have the numerator and the denominator. On the numerator, which is on the top, you take the high. So you'd take this high minus the now. So you'd take the 44 minus the 31. So you get 13, and then you divide 13 by the high 44 minus the low, so 24. So can't do that in my head. So sorry. So you just basically 13 divided by, what did I say, 24? So 54%. So that's, did I do that right? 44, 31. 13 and 44 minus 20, 24, 13. Yeah, so Apple is right at 54%. So see what it says, what they came up with. And that's the quick and dirty. I'm not getting exact either with the decimal points and everything else. But so it's 47. They're coming up with 47. Theirs probably goes back an extra month, because I think Thinkorswim goes back a full year on theirs. So and mine's the down and dirty. So Apple would probably fit in that camp for me, just a couple percent, and then my math comes up with it a little bit higher. So I'd probably make that one work. The other one, for if you don't have a lot like the $100 stock or don't want to deal with a $100 stock, is rig. We can look at rig real quick. And this is basically the steps I go through. I kind of go through the stocks. I just glance down here, kind of eyeball it. That looks like it's pretty close to being above the 50%. You can see right there would probably be about 50% for the most part on a down and dirty. So rig's been trending nicely back and forth. It's gotten hurt over the past year, but for the most part it seems to have found a bit of a bottom and looks to be like it could be a good trade. So if you're not looking at doing a $100 stock, or you have a smaller account where it's $10,000 or less or something like that, this might be a good alternative than doing an Apple and making your portfolio way overweighted. So right here's the 13 delta. I'd like it maybe a little bit higher, but the 17 delta could make up for it there. So on something like this, it's looking like a pretty good trade. You're getting about probably 40 some cents for it, which is pretty good for a $10 stock. Apple, you're probably going to get at least $1, which is nice to get the bigger commission or the bigger rate. So that one I would star. So I'm going to circle rig on my paper. And then, you can even go into the other one is Costco, everybody looks at, it seems like. I'm going to stay away from like Babas and stuff like that, but so see Costco, it's really going to want to push me into the really close to the monies on Costco. So that one's gone. Wouldn't even do that. And you know what? My guess is Costco's IV has come off a little bit. Yeah, looks like it's come off a little bit since I was thinking it was going to kind of push up. Even though Costco's been in a nice trend, I would probably have to not do that 44%. So, and I also have a position on in Costco, so just full disclosure. All right, so let's look at a couple ETFs. TLT, which is trending nicely. Everybody's talking about a rate hike, which would affect TLT. If they raise rates, it's going to go down. The next meeting is in September. Fed fund futures are pricing in a 50% chance of a rate hike in September. If you watch the daily market commentaries, I'm kind of fading that. I just don't really see the Fed trying to crimp spending going into the holiday season. I think that would be not really a great time to start that process. But despite the fact that I think they do need to start raising rates, I don't think that would be the right timing, and hopefully that they are seeing that. But it is at a high IV. Looks like, from just the quick eyeball of it. I don't have anything in TLT. It's just below 48%. So, or it's right at 48%, just below 50%. So that's something I would look at. I would circle that. I don't have any TLT on. So that's another, thing you got to take into account also. If you already have a couple of like gambling stocks, you wouldn't necessarily want to put Win in there because you don't want to get overweight those. Speaking of Win, let's look at Las Vegas Sands real quick. I think because it's about half the price and it's got higher IV, it looks like. You also don't want to do these around earnings unless you're going shorter duration and kind of getting a little further out. You don't even have to go with that delta theory that you'd be in the teens for that. So make sure these are clean cycles where you're not getting a earnings play in there, because that will throw off everything. Especially, if you do it a couple weeks before the earnings, all you're going to do is see that volatility increase going into those earnings. So you're going to be losing money going into it. So that's another reason why you don't want to do it, especially all the other risks that are going to be involved in that. So stay away from earnings, which all of these guys have had earnings. So this has a high IV. So this I would have to look at also. It's kind of juking back and forth. I think I like the way the wind was acting better than the way that Las Vegas Sands is. I think, yeah, they all kind of came in line. I think Las Vegas Sands was a little bit lower. So, I might kick that one to the curb also. All right, back to the, if you want to get into some energies, like oil and gas has been moving around a lot lately. You can see this has trended sideways lately. Still got high IV, which is good. Anytime you can find where it's trending side, usually you get a spike in the IV when these fall out of bed. Any IV is really, Vega is the fear factor in the premium. It's how much is getting built in there for fear of a big move. This has been trending sideways nicely for a short period of time here, which is good. I mean, I think it could go for another few days, and if you can get this volatility contraction and this theta decay right in this big downsloping area of the theta decay between 35 and 20 days, that's a good time to do something like this. So XOP I'm going to circle. So right now I have Apple circled, RIG circled, XOP. I probably wouldn't want to do both RIG and XOP just because then that gets you, too much into the oil sector. So we'd have to just decide which one we're going to do, whether we're going to see which one we get a better premium for, which I'm guessing is going to be XOP. Emerging markets has been juking around a lot. I think that emerging markets is a good time to get into it. I think it's going to move a little bit higher, but I don't like this 45-degree downslope. That's not very good. 1, 2, 3, 4. You could get another move and then another fall off. Plus, I think that there's just too much turmoil in the world right now to really get involved in emerging markets. So I'd probably stay away from that, even though it meets the criteria there. I don't like that downward slope. It's too downward sloping, too bearish. And USO is also another good one. USO is trending down. Looks like it could have found a bottom. It's got a high IV, which makes it. Let's just take a look at it. What is that, USO? So USO is above 50%, so that works it out. Go to our 35 days to expiration, because like I said, that's where you're going to start really seeing that theta decay. And the theta component is, where am I at? So this is your theta. This is how much is going to come out of these strikes every day. So that's what you're really looking for. You want to see the market really start sucking out for theta, and you're going to start seeing that increase the closer you get to expiration. So we would look at something like the 16 strike or 16 delta, which is right there at 16, and the other one would be right here at around the 12.5. So the 12.5 and the 16. So I go back to the charts. 12.5 is just slightly below here, and the 16, 16. Yeah, so right in this area, you're going to see a little bit of resistance. This acted as the support area coming down. It's going to act as a resistance area going back up. I think I could throw the Fibonacci on there just to see what it does, but I think it's still too low to really. All right, I'm just going to do it quick. I'm not going to line it up perfectly. Yeah, so whatever. So yeah. That's another thing I'll look at. 19 is where that fib level is. I do see there being a little bit of resistance going right here at this 15, 16 area. So that would be something that I would really look at. So you could circle USO, but again, that's another oil one. So I would, look at that because I don't have really very much energy in regards to oil right now. kind of got out of all mine. Also US Steel, I have a position in here, sold some calls in there, or sold a call spread, as you can see. So full disclosure. So, you know, in this, I would be selling these 23s, which is, you know, right where I'm shorted. I actually shorted the call spread. If you watch the webinar on call spreads, I usually do it at the 35 delta strike. So I'm in the money on that, or, you know, I'm making money on that one. So the 23 strike, and then I'd be looking at the 16 strike on the downside. So the 23, wait. So that's nice. The 23, that's the reason why I actually did this too, is put it on the 23 because it's on that Fibonacci level. So the 23 strike would be good for this. If you wanted to throw something like that. Yeah. 23 and the, I say the 16. 23 and the 16, which would make it a new low. So the 23 and the 16 would really be nice for this. It seems like it's staying right within those two right there. So that would be something I would look at doing. And then you just kind of go in here and you can do it as a strangle. You can do it we're going to do, they do the strangles really tight. So I just kind of look for the one on the call side. I don't know why I always go to the call side just to sell that and then adjust. 23 and the 16. Right, and you can do a confirm. So you can see your buying power effect is going down by almost $200. That's not too bad for $53 credit on a $20 stock. That's pretty good. So that would be something I would look at doing. All right. The other one, Apple. I really like that Apple one. And I don't have any Apple on right now because it has been trading in a trend. So let's look at Apple. So yeah, so you can see Apple's kind of stuck right in here. 50% retracement is usually a major support area on stocks, and you know this is acting as the resistance. So if we could get it outside of above 19 and below, you know, the 13ish area, which I think we can. So doing the 20s and Apple. So I would look at let's make sure that it lines up with the deltas. So the 25 is even better. So the 25s. So we can do the 25. So we're probably going to be able to get way down here. 25s. 25s and the 105s. That puts us right outside of those two Fibonacci levels. So that I like that trade a lot. So go to the strangle and 25s. What did I say on the other side? Does anybody remember right offhand? I forgot again already. 25s, 05s was it? Sorry, drew a blank right there. Sorry, guys. 25s and the 05s. Final answer. Selling the 25s, buying the 05s. Sorry about the dead air. $1.77, that's nice. 25s and the 05s. $1.77 buying power effect. Is, you know, that's how much they're going to hold in margin for you. to do this trade. So $174, that's a really good one. You know, I'm going to ship that one off. So then you just confirm and send. Wait for it. I usually will adjust it. I'm probably not going to adjust it during this, just because for time and stuff like that. Be a little bit, you know, it's kind of like, do you want the penny or do you want the trade? What do you want to do? I want the trade usually. All right, so Apple, and then maybe I think the XOP looked a little bit better than the rig. XOP, let's go to that. You guys have any questions so far out there? Am I moving too fast, or you guys getting all this? You can hit me up in the questions box. All right. Tommy, you getting out? Were you usually a buyer of options? Does this make more sense that you're going to be able to sell the options? Sell the options. You know, one thing I look at with selling options is, you know, you're rolling the ball downhill. You know, that's why I said it's a Sisyphean effort to roll up against, you know, the big boulder up the hill. Sisyphe was the guy who rolled the rock up the hill, and it's a Sisyphean effort. He never makes it to the top because the mountain never ends, but it's just a Sisyphean effort to roll this rock uphill when everything, momentum is pushing down. You got theta decay against you. You got vega against you. You know, whenever you're buying options, you just have to have all the stars aligned. You really have to have a massive move quickly to counteract the theta and the vega contraction. If you get the massive move, then that vega will help you on your buying and will go against the theta. But if it's just a slow grind up, you can be directionally right and still not make money. So this way, you know, you can be somewhat directionally wrong and still make money. That's why I like selling the options. You guys have anything out there you want me to look at? So XOP is trending sideways, $40 stock for the most part. XOP, let's go back, check out do this on every single trade. You know, you don't have to do it immediately. Rudy, you have a 401k account. You're going to have to do a defined risk strategy in that. So the iron condor would be the thing to do. But, you know, with this, you know, I don't know what your wings are on your iron condor, but you could do something like this in XOP. You could sell the same strike and then buy something really far out of the money super cheap, you know, and it creates the defined risk aspect of it. But, excuse me, at the same time, you'll see that you know, if you sold this, your vega, or sorry, your theta contraction is a lot more. Your theta coming out of it 2 cents a day is a lot more than, you know, 1 cent or zero for the most part. So, you know, that is somewhat of a loophole on doing those type of strategies if you really wanted to make it more like an strangle, or act more like a strangle than an iron condor. Usually iron condors, you only go 1 or 5 strikes away from your short, just to keep that defined risk. But if you wanted to have more risk, then you could do something like that if you wanted to, depending on your risk tolerance. So, but same idea for the most part. And on a, you know, iron condor, I'm usually looking at the 30 strikes, or the 30 deltas, I mean, you know, right in here. Whereas with these, I'm able to push out, you know, 4 strikes plus and get to that same, you know, that same pricing for the most part. If you're doing this and buying those, you're getting, you know, 40 cents there, whereas I can do this and get 40 cents and have more of a probability of staying out of the money. Okay, so you could do that the same way. You know, it wouldn't make sense to do this for 10 cents or whatever if you were going 1 strike, but you could go quite a bit out, stretch those legs out on the defined side of it. Does that make sense? Okay, so XOP, good. You know your risk though. If you don't like to take a lot of risk and you like, hitting for singles or whatever, and this is kind of a trying to hit for a double strategy where it's a little bit more risky, swinging a little harder, but but your probability of profit is a lot better with this. Your return on capital is better with an iron condor, but your probability of profit is better with the way that I'm setting up this type of strategy. So like we said, XOP, I think XOP is going to see resistance right here, especially if this, this is the trend line. So, selling something in the 45-ish area and probably buying something, below this 35 area would be nice. So XOP, let's look at it. So we'd be able to do the 45 and, the 34, probably even, even the 33, depending on the 45, 33. I'd probably go with this 33 just because I'm getting more premium, or actually 34 I'd probably go with just to try and get it to $1. I'd like to get $1 if I can, and for $39, $40 strike or stock, that's pretty good. So selling the 45. Did I say that? Did I say that? Let's just double check. So selling the 45 and the 34. Yeah, I'd do the 34 there. It gets you close to $1. Anytime you get $1 on this type of strategy, that's really good, especially with the way this is setting up. We're pretty far away. So that would be something I would look at for sure. You also want to look at sometimes, so $390 for putting on this trade is pretty good on the buying of power effect. Sorry, I had a side thought going on. So here's what I was talking about, knowing that there's a lot of trade going on. See how tight this bid-ask spread is? That's really pretty good. You get 5-6 cents between the bid-ask. You got a pretty good chance of getting filled on that. Some stocks like Apple are going to be even tighter a lot of times. So yeah, look at Apple's a penny wide. So that something like that is going to be easier to get in and out of a stock if the going gets tough. And this is, $100 stock. It's because there's so many players in there that people are willing to give up the edge on both sides. So it makes it a lot tighter for that kind of trade. So that's what we were looking at for that. So we got this in for there. You guys have anybody have anything out there that you want me to look at for you? All right, we got our XOP. Any stocks you guys always look at that you think might be in a trending pattern that would want me to look at? All right. Sounds good. Well, that's about all I've got for you guys today. You can go check out protraderstrategies.com. We've got, for you guys that signed up for that, somebody threw up their price line. But, you can get all my daily market commentaries. You get the trading lesson videos, which I've done quite a few of those, and the trading workshops, which is these webinars. And because you guys participated in this, you can go to protraderstrategies.com and get a bit of a discount there. And the last thing I want to say to you guys is thank you very much. Appreciate it. In later webinars, we're going to be drilling down on different option strategies. We're going to be looking at the strangle in a future one coming up. the straddle, which is another way to do this type of strategy in a sideways market. We're also going to be talking about if we had this strangle on, we could move it into, if we were getting tested, a straddle. So I'm going to be talking about both of those in that. And you can go to protraderstrategies.com. If you go into the chat box, you can just click on the link and it'll take you there for that deal that we just talked about. And if you have any questions, you can contact us at 310-598-6677, or you can email us at trading@protraderstrategies.com. I hope this was great for all you guys, and the more the merrier, so show up for the rest of them, and you guys can email us and give us some ideas as to strategies you might want us to look at for you. And I hope you guys all have a great weekend. Thanks for joining. Thanks for participating. I appreciate everybody's back and forth and all the commentary I get on the questionnaires or on the question box. So I appreciate it. I hope you guys learned something. And hey, one other thing, go back when you get this sent to you in the email and go over it one more time, because that will make it really sink in. I know I went over some things really quickly, and the reason why I did it in the beginning really quickly was to get to the end on their live trading. So watch it again, let it sink in, and do that relatively quickly before you forget it all. All right? If you can't take that, take it easy.